Hello and welcome to Your Stocks on CNBC-TV18 in the Mumbai News Studio. I'm Ekta Batra. Well, it's turning out to be a session where we are seeing some amount of traction in the markets. So we have the Nifty, which is up around 0.5%, the mid-cap index, which has picked up pace as well. So up around 0.8% currently for the mid-cap index, and the Bank Nifty, which is doing well as well. So up around 0.6% currently for the Bank Nifty. In terms of the advanced decline ratio, largely even keel. So 1:1 is currently where the advanced decline ratio is at. But on the show today, we have a special conversation lined up to discuss the big run-up in equities, the retail rush that we've seen, SEBI's recent measures in terms of investor protection, as well as the IPO rush, and a lot more topics to cover. We have Dhiraj Relli, who's the MD and CEO at HDFC Securities, joining in for a special conversation. Dhiraj, thank you very much for joining in to our studios. Well, I want to start by discussing the big run-up in equities that we've seen. You know, the statistics are mind-boggling. Nifty's up around 46% from those March 2023 lows and sitting at record highs almost every single day. Give us a sense in terms of where the markets would go from here on, and do you think that there's a bit of a valuation stretch?
So, hi. Thank you for having me. I think this has been the bone of contention for all market participants and investors as well, whether markets have run ahead of the earnings. I think if you look at last 4 years or so, earnings have compounded almost 18% compounded annual growth rate. So to that extent, I would not say that the valuations are stretched, but you know they are stretched to some extent, but not euphoric for sure.
Okay,
yeah.
So not euphoric for sure, but do you think that this incremental amount of flows that we've seen from, say, DIIs would probably then continue on a continuous basis? And where would the FII stand when it comes to, say, sustained investments into the Indian markets?
So look, first, you know, currently, if we look at the Nifty, it is, if you look at forward EPS of FY25, it is at 23 valuation. So to that extent, valuations are a bit stretched. It's at +2 standard deviation levels. And it is largely on the back of domestic flows. You can't quarrel with the liquidity. We have seen enough and more investors participating in the capital markets through direct equity route or through mutual fund route. All of us are well aware of how we are getting the inflows in the mutual funds. We recently got the data for June month. SIP flows are at 21,262 crores level. We got equity mutual fund flows of 40,000 plus. So to that extent, you know, there have been robust flows from the domestic investors. Even if you see the new additions in the DMAT, almost 43 lakh accounts have added in the last month itself. So from that point of view, we are seeing more and more participation coming in from the retail investors, and I think this trend will continue. I was looking at the SIP data on a year-on-year growth. It is almost 44% growth in 1 year. From a 14,000 crore, it moved to the 21,000 crore. So we are seeing more traction from the retail investors, and I don't see this as a short-term trend. This is a structural theme, and this will continue for some more time. And I think I call it equitization of investments. You would have heard about the financialization of savings, and everyone talks about that we are now, investors are now moving more and more money to the financial assets. But within the financial assets also, there is a shift towards the equity as an asset class. And this is on the bedrock of change in the behavior, aptitude and risk appetite of the investors at large. Still, if you look at the equity penetration, this is just about hovering 5-6% versus China at 14% and US at upwards of 61% or so. So to that extent, I think we have a long runway ahead of us in terms of domestic inflows. Coming back to the FPI's inflows, I think we are not seeing any significant change in the trend, either on the positive side or on the negative side. It is all got to do with the liquidity. FPIs do have a liquidity, but they have an alternative options to leverage that liquidity to another emerging markets or to other asset classes. And for them, when you have a market cap to GDP ratio of 145%, and most of the other emerging markets are less than 100%, I think they have an option to move the liquidity somewhere else for the time being, whereas domestic liquidity is more married to the Indian domestic markets.
Okay, all right. Well, just talking about the SIP flows, then you expect this number that we've seen, say that 21,000 or a crore number that we saw in the month of June, to probably expand on a month-on-month basis?
In fact, I authored one article on how this SIP flows can improve. So if you look at the 2016 to now, this has been growing at a compounded annual growth rate of almost 2% per month. Okay, and if we use the same 2% per month extrapolation, by January 2028, this should be 50,000 crore, and December 2030, this should be 1 lakh crore. I know it's an extrapolation only, yeah, but we are extrapolating on the back of 8 years data and not just about a small period trend.
Okay, but no kind of short-term correction would probably deter the investor, even if it's a significant enough correction which could probably take place.
See, we are also seeing some kind of a closure in the SIPs, and that has also been amply covered in the media, that there are closures in the SIPs and so on. But my take is that, that is part and parcel of it. Some people would have some requirement, some urgency, so they would take out funds, move from one SIP to another SIP, because new thematic schemes are coming up, newer sector rotations is happening in the market, so they may want to move from large cap to mid cap to large cap, and so on. But structural trends are very much intact, and I'll tell you why it will grow from here onwards also. The average ticket size for SIP is 2,368. I think this is too small an amount. Even if you invest 5,000 rupees a month, it is 60,000 per annum, and 10 years, 6 lakh rupees only. Whatever compounding you may choose, it will go to only 15 odd lakh rupees. So what can you buy 10 year hence at 15 lakh rupees? Not even a decent sized car, and forget about the home. So my take is that I think there is this concept of staggered investing in the form of SIP has been sold, and people are well entrenched with this as a concept. So my take is that now is the time where not only number of SIP will grow, but also we will see that the value will also increase, ticket sizes will also increase. We have already started having this conversation with our investors. Look, you've tasted the success. It's time to put a sizable amount in the form of SIPs. And in any case, coming back to your question, are these the right levels to invest in the market? By the way, I've been grappling this question for last 20 years when around 2005, Nifty was at 5,000 level also. Then also everybody questioned, is this a right level to invest in the markets? My take is that the retail investors particularly have cracked this problem, because they can't deal with the volatility. They have figured out a solution called SIP, and they're very happy with this solution.
Okay, but what is the near-term risk for the markets? Are you expecting probably any kind of risk which could result in a correction? If so, how much could it be incrementally?
See, when you are having a stretch valuation of mid cap, small cap at 26, 27 P multiple on FY 25 earnings, obviously the margin of error is huge. Any kind of a negative news from the market, any negative earning report can lead to a dramatic correction in the market, and 10 to 15% kind of a corrections can come on the back of FPI's outflows, inflation remaining stubborn, some geopolitical issue in the Middle East, and so on. So there could be many more factors that could derail the momentum, but that correction would be healthy correction, and as I said, that staggered investing is the way to go.
But we're not in that frothy zone when it comes to mid caps and small caps as yet.
Most of the mid caps and small cap stocks at their level are run ahead of the earnings expectations, and there is a froth in the valuation. When you are operating at a 80 to 100 P multiple, you can't say that these are fair valuations, and particularly when the earning trajectory is also on a base looking now onwards tapering off. See, total earnings grew in last 4 years at 20%, but what we are seeing in our universe, the earnings will grow at 12 to 13% only. So if earning growth is not aligned with the valuations, then the corrections can be steeper. So my suggestion is that right now, if investors are looking forward for a new entry in the market, the best way for them to go to about certain sectors where we haven't seen the stretch in the valuations, and that's what we saw in the IT sector last week. I was looking at the top 5 gainers in the Nifty. All 5 stocks were IT stocks only, and they've gained 3.5% to 6%.
Okay. Well, just talking about that, then would you recommend maybe retail investors should probably look at an IT-specific fund or reinvesting or reallocating their funds towards IT?
I think thematic funds are for more evolved customers. When they have invested in most of the other forms in the equity, then they look at specifically leveraging thematic funds. My take is that large cap or Nifty ETF would be a better bet for them. What we are advising our customers is diversified portfolio and not so much concentrated portfolio. One can look at equal weight Nifty ETFs also. One can look at large cap funds also. We know that there are some leg room for the upside in the BFSI space, particularly in the private sector banks and few large PSUs also, and also the asset management companies and insurance. So to that extent, IT is also one space which will contribute to the growth of these large caps. And also we are seeing some green shoots in the rural demand. So to that extent, that would impact the FMCG and staples and some discretionary stocks as well.
Okay. Well, you know, SEBI has been extremely active when it comes to investor protection. For example, the recent measures with regards to the criteria for entry and exit of F&O stocks, and they're focused on market development, investor protection and risk. From that perspective, do you expect more measures from SEBI, and how important would it be for investor protection?
I think the criteria to include and exclude stocks for the F&O was something changed in last 2017-18. Since then, the volume and the traction has changed in the market. That was something discussed at length in Secondary Market Advisory Committee of SEBI, and I am a member of that committee. So to that extent, we had a full calibration, and based on the current need, that criteria has changed. It wasn't intended to reduce the number of stocks. It was just to get the right set of stocks to be in the F&O. SEBI has been taking some slew of measures to ensure that if there is any euphoria in the F&O space, that can be addressed. To that extent, more action is on the anvil. Today also at 5 p.m. we have one meeting, and I can't give you more details on what we will cover in that meeting. But I think in a nutshell, these are steps in the right direction, and this will bring in the sanity in the markets.
Okay, all right, Dhiraj, it's been a pleasure. Thank you very much for joining in and speaking to us about a whole host of topics with regards to the markets. Thanks very much, and we'll surely touch base with you and discuss any kind of incremental SEBI measures which come through as well. We'll take a short break, but more news and updates on the other side. Stay tuned.
Phone pay